Thank you for joining Jennifer Schultz and Associates in our 2019 Webinar Wednesday series. We are coming to you live from downtown Washington, D.C. Our webinars are every Wednesday, and you can find the upcoming schedule on our website. Past webinars and all recordings are also on our website and on our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speaker today, you can email him directly with the contact information you'll see on the last slide. This is just a little bit about us. We are a Washington, D.C. based firm and provide services for federal contractors. This ranges from market analysis reports to proposal writing, and also post-award compliance. More information is on our website, so please visit us there. This is an upcoming event that you can find more information here, also on our website. And we do offer advertising, so you can email me if you would like more information on that. And our webinar today is sponsored by AccuTrack. Here's a short message from them.
AccuTrack Consulting and Accounting Services is an 8A WOSB CPA firm committed to supporting entities sustain growth in government contracting. Our outstanding DCAA accounting solutions reduce audit risk, improve cash flows, and give you peace of mind. Contact us today to learn how we can enhance your DCAA accounting efforts.
All right, let's go ahead and get started. Our speaker today is Don Kenneth, and he's going to be covering the impact of new GovCon revenue recognition. Don, I'm going to go ahead and hand it over to you.
I hope we have the right deck up here. Can we just go ahead one slide so I can check them out, Mallory?
Yeah, which?
Okay, this should be the one that says, impact.
Okay, let's see.
Sorry about that. By the way, while Mallory's checking that, yeah, that's the one that should be up there now. So I'm Mallory's checking. I'll introduce myself. My name is Don Kenneth. I'm a principal with E. Cohen & Associates, and I have a bachelor's degree from George Mason University, as you saw. I've been doing government contracting for going on 40 years. Spent 15 years as a partner in a national accounting firm. And so government contracts is kind of a part of my life. So some of you may have been on the earlier webinar where we talked about the basics of the new revenue recognition standard. Here we're going to talk a little bit more in depth about how they're going to impact government contracts. So one of the things, just to start out with, companies that have fixed price contracts, government contractors, have largely relied on the AICPA's old Statement of Position 81-1. It's called 81-1 because it was issued in 1981. And it deals with performance construction and construction type contracts. And essentially, you could parse that to mean long-term contracts. That was the real intent of the statement. It was modified a long time ago after the SEC and some other entities objected to exclude service contracts because they weren't thought to really come under the guidance there. The big distinction was that typically in construction contracts and production contracts, the buyer is taking possession progressively as the work completes. So if someone contracts to build a building, as the construction on that project progresses, the buyer actually obtains a title interest in it. And the same is true of things like aircraft. Boeing specifies a specific plane that is yours, and you can see going through the production line and monitor its various stages. With service contracts, it's not really the case in many instances. The government, the customer, in this case the government, may not be getting anything of value. And real quickly, I'm going to use a CPA audit as an example. Typically, if we do an audit of somebody's financial statements, it takes place over a period of a couple of months. There's perhaps a few weeks of planning and then a few weeks of field work, and then there's stuff that goes on. But it's not totally unheard of for extend beyond a year if there are complications, and I won't get into what those might be, but they sometimes happen. So the question becomes: has the customer received anything of value up until and has it taken ownership of anything until the actual statements are completed and issued? And the answer in many cases would be no. Audit's not worth anything to anybody if they don't have the actual financial statements. And so the same question arises with government contracts. So in any event, this statement was completely superseded when the Financial Accounting Standards Board issued what's called its Codification of Generally Accepted Accounting Principles in 2005. We went from having many, many FASBs. When I started my career, they were on number 34. When they went to the Codification in 2005, they were on FASB 169. So that's all done now. Everything was put into this codified, massive document. And from that point on, we have now what are called Accounting Series Updates, ASUs. So we can go to the next slide. We talked about this in the preceding webinar. Many contractors continue to use 81.1 as a justification for applying the cost-to-cost percentage of completion method to fixed-price government contracts, and that actually is not a proper justification. Again, the codification doesn't actually provide for that on service contracts. 81.1 ceased to have any authority in 2005. So now we got a new revenue recognition standard coming out, known as 2014-09, because it was originally issued in 2014. Its genesis goes back further than that. I want to say 7-8 years. It's been in the works. When it came out in 14, they'd already been working on it for at least 3 years, might have been 4 or 5. And it was part of what was known as a convergence project with the International Accounting Standards Board. The idea was to bring U.S. accounting standards more in line with those of the IASB. They're easy because increasingly business is global, and companies can locate anywhere in the world in some instances, and so they don't want to have to report under standards that are so different that one country might not want to accept a set of statements. It hasn't totally worked, and they've now pretty much abandoned the idea the SEC will ever accept it. But I just wanted to point that out. It was part of a convergence project, and the important thing about that is the IASB standards have always been less prescriptive than US GAAP. The IASB says, here's the objective of what we're trying to accomplish in, let's say, something like revenue recognition, to see that revenue is recognized ratably as it's actually earned. Whereas US GAAP has always been very prescriptive, kind of like the Internal Revenue Code. Lots of details, lots of specific things. And so one of the things we CPAs get paid for is to figure out how to get around the rules as rapidly as they write them. I say that only partially tongue-in-cheek. Let's go to the next slide. Another standard that was incorporated in the codification that had a lot of that impacted government contractors significantly was something called the Emerging Issues Task Force 0021, meaning it was number 21, issued in 2000, covering multiple element arrangements. And by the way, this gives you a good idea of just how disjointed GAAP was until the codification came along. So you had the AICP out here with this SOP. You had this special branch of the FASB covering things that had to be covered rapidly, for which the FASB didn't think it had time to do an actual project and issue a formal standard. And so it really was a hodgepodge. The EITF was extremely complicated. It was modified several times, but essentially the idea was it required you to analyze all of your revenue producing arrangements, which were often contracts, and look to see whether there were different accounting units included that should be accounted for separately. And I'm going to use again this example of a cellular phone company. When you go and you sign up for a cell phone, these days in particular, you're buying a cell phone and paying a monthly amount for it. And it's actually stated as the charge for the phone, which is why you can get an upgrade every year nowadays. But then you're also separately paying for service, monthly service, and you may be paying for other things like equipment protection. You may be buying accessories. You may be buying other peripheral products. Those are different elements under this concept of multiple element arrangements. And while we no longer have EITF 0021, the new standard actually does take this into account, as we'll see shortly. So let's go to the next one. So it's effective this year in 2019 for private companies. It radically changes the way SOP 81.1 and EITF 0021 operate. even as they were incorporated in the codification. And it also affects numerous other existing revenue recognition guidance that were found either in the codification or in industry guidance and so on. Now, some GCs will experience very little change from the topic, the change topic, which is now known as Topic 606 and largely replaces Topic 605. If you've got straightforward time and materials contracts, and if that's all you have, the likelihood is that there won't be that much of an impact. If you've got cost plus contracts, there's likely to be more of an impact. If you've got fixed price contracts, there's likely to be a lot of impact. If you've got things like you're part of you've got a blanket purchase order, or a basic ordering agreement, or an IDIQ contract, or you're part of a GWAX, which we often talk about as a hunting license. That's all it is. You're going to find yourself affected by this. So let's go to the next slide. I think I've already pretty much mentioned this. The new standard is incorporated as Topic 605 to the codification and supersedes most of 605, and it supersedes in particular some cost guidance included in subtopic 605.35 revenue recognition. I'm not going to read the rest of that. Essentially, long-term fixed price contracts, which technically hasn't applied to service contracts for years anyway, even though people have continued to act as if it does. So let's go look at some of the ways this is going to actually impact GCs. So as a quick refresher, the basic part of the new standard centers on a 5-step approach to evaluating contracts. And those are identify the contract or contracts with customers, identify the performance obligations, that's a key term in the contract, then determine the total transaction price, then allocate that transaction price to the separate performance obligations. Both of these steps 3 and 4 sound easier than they actually will be in the implementation when it comes to government contracts in many cases. And then finally, recognize revenue when, if you're talking about a point in time, or as, if we're talking about overtime, the entity satisfies a performance obligation. And we're going to look at how each one of these just briefly has some potential to impact government contractors. So we can go to the next slide. So step 1, identify the contracts with customers. Well, that might sound easy. You say, hey, I got a contract, got a number, it's been signed by the government. The topic identifies a contract as an agreement between 2 or more parties that creates, and this is an important clause here, enforceable rights and obligations. And there are 5 basic criteria to be evaluated, determining whether something constitutes a contract. I'm not going to go into those, or we wouldn't be able to get through everything we need to cover in this short period. But there is guidance in there as to how you decide whether something constitutes a contract. But let's look at a couple of things that don't or may not constitute a contract. I think I have those on the next slide. So, for example, the topic states that a master agreement generally is not a contract within the scope of Topic 605. Now, we don't often use the term master agreement in government contracting, but I'll give you an example of a master agreement in, let's say, just the pure commercial world. A company may sign an agreement with someone like Dell, okay, to purchase all kinds of things from them, everything from, individual computers to software to maintenance services to consulting services, and they'll typically arrange for a credit line with them, and then against this master agreement they'll issue purchase orders. The master agreement itself is not a contract, all right? And so that means that when we get into the government environment, things like blanket purchase arrangements, IDIQ contracts, they may not qualify as contracts in themselves. Instead, the individual purchases, task orders, or whatever will constitute contracts, and those are going to be the vehicles that are subject to applying the Topic 606 requirements. Another question is whether an unfunded option year counts as a legally enforceable agreement prior to its actual exercise and its funding. Because as we all know, the government cannot legally obligate funds beyond 1 year, which is why every contract that's long-term is structured with option years. Because in order to proceed with the option year, the government has to exercise it, and then even then it has to fund it, unless you want to work at risk. So these are all factors to which there aren't cut and dried answers. I expect that the FASB will issue additional interpretation over time. CPA firms will be petitioning the FASB to provide guidance, and we'll see that. All we're going to have right now, in all likelihood, is we'll be able to look back at how public companies filed, because they were required to begin complying, I think in 17, but it might have been 18. And we'll be able to look back and see how they've been handling this. There's some large public company government contractors whose 10Ks we can pull down, and we'll look at how they've been addressing some of these issues. And I think that will help give us some guidance, because the SEC is a stern taskmaster, and if it flies with them, then likely it would fly with anyone. So let's go to the next one. So now we have to identify the performance obligations in the contract at step 2. And this is going to be a challenge. Contracts have multiple elements. We've got option years, we've got tasks, we've got CLINs, we may have purchase orders. Each of these is potentially a separate performance obligation, and they may be standalone performance obligations that we can clearly identify, such as a purchase order issued under a basic ordering agreement, or it may take some doing to figure out, well, what is the performance obligation? Is it the task, or is it specific CLINs within the task, or is it an option year? It's not going to be as simple as we'd like it to be. Topic 606 states that if there's if more than one good or service is promised, it's a performance obligation only if it's distinct, or it's a series of distinct goods and services, that should be and services, that are substantially the same or have the same pattern of transfer. So, for example, number 2 could be a distinct service with the same pattern of transfer. Might be a maintenance contract where you agree to perform maintenance, or staff a help desk. That conceivably could be meet the qualifications of number 2 as a performance obligation. So we're going to be wrestling with that. Let's go to the next one. There are 2 specified criteria in meeting this term distinct. The first one is capable of being distinct, which means the customer can benefit from the good or service on its own. So it's distinct only when that's the case. So 1 month of service on a maintenance contract could conceivably be a performance obligation. 1 month of service on a help desk could conceivably be a performance obligation, because the customer benefits from that good or service on its own in that short period. The other is that it's distinct within the context of the contract. So the promise to transfer the good or services is separately identifiable from other promises. That's pretty nebulous. I don't think that one's going to be all that easy to apply. So, there's more guidance in the actual statement, but I'm shortcutting a little bit here so that we can get through everything. So let's move to, I think step 3 is next. Determine the transaction price. Well, that's going to hinge at least in part on things like, are the option years part of one contract, or are they separate contracts? What about incentive and award fees? Those can complicate the determination of the contract price. Let's take as an example a cost plus award fee contract where you've got a base fee and then a potential award fee of, let's say, up to 4%, and it's typically determined quarterly. You've got to make some assessment up front of, well, what's the transaction price? How much of that award fee should I count on? And so that's just one, and I think relatively simple example of what could complicate this thing. So we're going to have to deal with that. Let's go to the next one. So there are a variety of elements in determining the total consideration. Variable consideration is the one that's most likely, and that's what I was just speaking of when I said award fees, incentive provisions, all of those things. But the question of how to view option years is also going to do that. if you've got an IDIQ contract where there's a minimum and a maximum, that could pose some difficulty because your cost of production could be different depending on whether the government exercises the minimum or the maximum. Sometimes there are pricing considerations that are related to how many that they take. So all of these things will make figuring out the total consideration, somewhat more complicated. Under the old GAAP arrangement, we didn't have to deal with this as much because we could simply say, well, okay, the incentive fee is revenue when and if it gets realized. It would have been looked at in most cases as what GAAP calls a contingent gain. GAAP always opted for conservatism in the old days. Now it opts for neutrality. So for those of you who think that went to school and got your accounting or your business degree at the time when there was something called the matching principle and the principle of conservatism as pervasive GAAP, those have both changed. Again, this will be more complicated than it's been in the past. Let's go to the next one, which I believe is step 4. Now we've got to allocate the transaction price to performance obligations. Most of us would have defaulted in the past to the contract itself. We would simply say, well, this task is specified right here on this line as X dollars, and this claim is specified right here as X dollars. It's not necessarily the case that we'll be allowed to do that under the new guidance for a separately priced element of a contract. It doesn't follow necessarily that the correct allocation under GAAP is going to coincide with the line item pricing in the contract. The basic requirement is that for a contract that has more than one performance obligation, you have to allocate the transaction price to each one in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for satisfying each performance obligation. Now, that in and of itself might say, well, that gets us right back to what the line item pricing says, but we're going to find that that's not always the case. Let's go to the next slide. So let's just talk about a couple of things. We could have milestone billings, and there are some milestone billings. You typically see this a lot now in service type contracts, particularly involving things like studies and surveys and analyses, where the government lays out a set of objectives and then the work product, so to speak, typically is at the end of a monthly period, and the work product consists of a report. And once the report is accepted, you typically can bill, and that bill that is considered a liquidated obligation. And in other words, you've satisfied the government requirement by issuing the report, the government accepting it. The question then is that milestone billing, though, if it's just based on taking the contract price and dividing it up by 12, that may or may not represent the appropriate allocation of the contract price. Sometimes milestone billings are just based on the lapse of time. The contract specifies you'll get the same amount of dollars, or not necessarily the same amount, but certain dollars at certain contract intervals. And it really takes on more of a financing element than a pure, this is really what we're paying for at that particular point. So that's going to complicate matters. And the new standard requires a company, I've said GC, but it's not specifically just GC, to determine the standalone selling price of each performance obligation at the contract inception. So the other thing is, at the time you do the contract, that's when you have to identify these performance obligations, at least initially. And that is when you determine what the standalone selling price of that item would be. There's a lot of guidance in the actual standard on that, and much of it derives from the old EITF 0021. But the point is that if you overstate the pricing on that, and I've seen this happen, I've seen instances of government contracts where the government basically, in order to be able to accommodate the contractor, would price something that was being delivered up front at higher than what it would really sell for in the marketplace, so that the contractor could, receive what is the equivalent of contract financing, because we see less of that these days in terms of progress payments and stuff like that. It's not going to be as simple as defaulting to the line item that's in the contract. I'm going to leave it there and move on. And then the last one, recognize revenue when or as the entity satisfies a performance obligation. So a performance obligation is satisfied when the entity transfers a promised good or service to a customer. Now, this is key. A good or service is transferred when or as, because it can take place over time, the customer obtains control of that good or service. And this is where the big question comes into play. And I realize we're running right against the mark, so I'm going to just harken back to what I said earlier. There are long-term things we might be working on for the government where they are not obtaining any control or, in fact, any value from that good or service because it isn't worth anything to them until it's complete. And this is going to be especially true of a service-type contract. A lot of contracts for services that are incomplete are not controlled by the customer, and they don't have any value. I think we're almost on the last slide. Let's go one forward here. Next slide. Okay, so real quickly, so this satisfaction of performance obligation can occur over time. And there are criteria actually provided in the standard. The customer simultaneously receives and consumes the benefits provided by the performance, or the performance creates or enhances an asset that the customer controls as the asset is created or enhanced. That would certainly be true for a building. Performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. So if you have an enforceable right to payment, even though the performance hasn't created an asset that the entity could use on a standalone basis if you were to walk away from the work for some reason, but you nonetheless have an enforceable right to payment, you may then still be able to recognize revenue on it. But again, none of this, as you can see, is really consistent with the old cost-to-cost method. So, we're going to probably see something like what those of us who have made our clients move away from cost-to-cost to what we call proportional performance. And some of you may think that's another way of saying the same thing. And in some cases it is, but not always. It depends on how that proportional performance is measured. Essentially, you have to meet a standard that something has transferred, something of benefit is transferred to the customer on a continuous basis. And whereas that's true in a building, as each additional floor is added, the customer actually is controlling it because title's passing, and so there's little doubt there that that's something of benefits to receive. Does it have a standalone use even if it's not completed? Well, not technically. You need a roof on it, but they can always go get somebody else to do that. So it does have standalone benefit. With service contracts, we are not going to always see that to be the case. And again, some companies that have been used to recognizing revenue ratably are going to find themselves having to recognize it only when the work is complete. And that's going to be a major change, and it's going to be lead to some major calculations. And I think we have one last slide, I think. Real quickly. Okay, so I think I've already gone over this. Revenue can occur at a point in time if the provider has a right to the payment, legal title of the asset passes, physical asset transfer passes, customers gotten the significant risk and rewards of ownership. We can just go to the next one, and they've accepted the asset. Maybe you got a DD-250. Go to the next one. Yeah. Okay. So really, here I'm just reiterating what I just said earlier. So I won't belabor the point here. But it is likely that some contracts using percentage of completion in the past are now going to be forced to go to complete a contract. I think we do have one last slide, so I'll just squeeze it in here. Is there one more? Yeah. Okay, so yeah, so all I want to emphasize is this requires an in-depth knowledge of its requirement. We're missing a word there. Topics really lengthy and complex, 300 pages long for the original ASU. And one of the things I do want to point out is, independent CPA firms doing audits are going to be walking a fine line in helping you out. Okay, now some firms are going to be willing to, step over that line dangerously, but CPA firms are not supposed to be doing accounting because they're auditing that. And here where we have these very complex calculations that have to be made, CPA firm really is going to be put in a rock and a hard place if they're forced or you're asking them to help you decide whether something is percentage of completion or completed contract. I can tell you that nationally that the large firms have made their clients go out and get independent advice if they have questions about that because they don't want to run afoul of the SEC. And I think I've taken it right down to the wire. Appreciate everybody for listening. And again, my contact information with eCohen, I think, is available if you have questions, want to email me. And thank you for allowing me to participate. Turn it back over to Mallory.
Thank you, Don. Thank you for participating and for all your knowledge and insight today. If you have questions about today's topic, you can contact Don with the email shown on your screen. This concludes the webinar. Thank you, everybody.